Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Life throws many moments at you, some major triumphs, some awkward mishaps, and some real lows. In this Real Talk series brought to you by Guzman y Gomez, we're going deep on some of the highs and lows of our investing journey. Welcome to Equity Mates Investing Podcast. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We're doing this Real Talk series with GYG while we take I was going to say a well-deserved break. I guess that's in the eyes of the audience. We think it's well-deserved. But I think it's a really good opportunity for us to pause and reflect. And over this series, we're reflecting on how we got started investing, how we think anyone can get started at any age. Today, we're going to talk about our portfolios, reflect on what they look like and why they look like the way they do. And I've got a very exciting announcement that I have finally taken the plunge into ShareSite.
Oh, so I joined ShareSite.
I can give you some serious granular data. We'll get to that. And then we're also going to reflect, on the story of Equity Mates and some of the best and worst advice and finance habits. So I think for us, it's been a big year and it's a chance for us to reflect, get real, and talk about it. And today, as I said, we're talking about our portfolios.
We are talking about our portfolios.
The most vulnerable that finance podcasters can be.
That's it. We're opening it up. We're keeping it real. We're having a burrito on the side. Thanks to Guzman y Gomez. Well, where do you want to start?
Well, I think let's start with you. We'll save my big reveal to the end of the episode. So I guess what we want to cover today is, first of all, how we think about the portfolio construction. We both are big fans of core and satellite, so let's explain that and how we build it, and then we'll go individual positions and then how it's gone.
I break my portfolio into a core and satellite.
Yep.
And as we've, practiced what we preach.
Yeah. Put our money where our mouth is.
Put our money where our mouth is.
Put our burritos where our mouths are.
That's it. Now, in theory, I have an 80-20 split in how I sort of invest at the moment.
Yeah.
However, in reality, my portfolio doesn't reflect that at the moment.
I'm just mindful that some people will be new to us. Some people have heard us talk about core and satellite for years, but for people who are new, core is essentially you want to have investments that just give you the market average return. You're not trying to do anything crazy. You're just trying to own a little bit of everything in a low-cost way and just say, however the market moves, the overall collection of every stock on the stock market, we'll just take that. And then satellite is where you say, I'm going to try and beat the stock market. I'm going to try and pick individual stocks or active managers or thematic funds, get a bit spicy and try and do better than just whatever the market will give us.
I'll start with my core.
Yeah.
So my core portfolio is made up of ETFs, 4 ETFs. So I've got exposure to the US through GGUS, which is a leveraged index fund. I've got exposure to Australia through GEAR, GEAR, which is a leveraged Australian fund. Then I have Asian exposure, VAE, Vanguard Asia X Japan, and a European ETF, which is VEQ, another Vanguard ETF. Those are my 4, and I dollar cost average into them every month at the moment, and that is done, and I'm super happy with that. Automated, end-to-end process, don't have to think about it. Then I have 2 thematic ETFs, Semiconductor ETF, SEMI, Global X, and ATEC, which is the Australian Technology ETF, tracks the Australian Technology Index, and that is a beta shares ETF. Those 6 ETFs make up 67% of my portfolio at the moment. So that's the, ETF and thematic exposure. My next largest holding, Ren, would you be surprised, is actually Bitcoin.
I wouldn't be surprised.
Oh, really? It's not something that I would recommend having a position that large, I would say. Like my original thinking with cryptocurrency was to have a position size that I would be okay to go to zero on because of the sheer speed at which Bitcoin can move and can go to not zero, but it can fall pretty quickly. I would be pretty annoyed if I lost 14% of my portfolio at the moment, but it's just because this position has run so hard that it's fast taking up a larger and larger portion of my portfolio. There's probably an argument that I should try and rebalance that at some point, but with Bitcoin in another run at the moment, what do they say? Don't cut your winners. So I'm not going to cut it. I then have six individual stocks: Berkshire Hathaway, Warren Buffett's holding company; Eli Lilly, Supermicro, Transmedics, which we've spoken about on the show recently; a little bit of Alphabet, I have sold down most of it; and Macquarie Bank. So pretty concentrated individual stocks. And then for my small cap exposure, I have given about 8% to Fairlight Asset Management. So Fairlight Asset Management are a small cap fund manager here in Australia. They are a global small cap fund manager, and we've had them on the show a couple of times, Will and Nick, and I just love how they approach it. Love their passion and towards small caps, and they've done pretty well. So I have 8% in small caps. Then I have a bit of cash on the side sitting in my offset account. So I guess to wrap that up, 67% in ETFs, 14% in Bitcoin, 11% in individual stocks, and 8% in small caps or in active management.
Nice.
So that's the construction.
I guess the big question is, how has it actually gone?
So the last 12 months, I have invested 23.16% of my after-tax income.
Okay, nice.
So this is for FY25. Then the remaining sort of free cash flow I have in savings or dry powder. But how's it gone? 19.95% total return for the past 12 months.
And that's across everything?
Everything.
What about at an individual level? Like, has your, like the theory around your satellite portfolio is it should outperform your core?
Yep.
And if it doesn't, then you should just be 100% core.
Yes.
Has your satellite outperformed?
So my satellite ETFs have outperformed. ATEC was up 30% in the financial year FY25, so that outperformed.
Okay.
Bitcoin this at the time of recording, up 73%. Probably up more than that now, but Bitcoin up 73%.
Yep.
So it's outperformed. And the best performing stock in there was up 65%.
So those are some of the winners.
Yeah.
I noticed that they're probably your biggest winners. Mm-hmm. No losers in your satellite portfolio?
Well, the satellite portfolio is pretty concentrated, Ren. And the only loser in there at the moment is the Alphabet position, down 6%.
Nice. Not bad.
For the last 12 months. I'm pretty happy with it. I think I would look at it and say that I probably could do a little more in the individual space, but the way that I allocate at the moment, most of the money that I am actively investing is going into the core ETFs, is going into the leveraged. You know, it was a pretty interesting experience. I've been through 2 or 3 pretty significant drawdowns with leverage. Been through COVID, I've been through the 22 and also now Liberation Day. And I would warn anyone who's just started investing and anyone listening that thinks it is a good idea. I do believe long term, but you certainly have to be very wary of the speed at which they can fall.
Yeah.
It completely destroys your portfolio. But if you look at how they've rebounded since, like obviously markets are at record highs. If you'd panicked and tried to sell, like all of the leverage products are now absolutely booming. And it's just, something to be wary of. I'm just cautious of people tuning in for the first time. Any questions?
No questions. To be honest, I've heard it before.
You have, yeah.
So I think the key takeaways for me, this is a real talk series and we want to get real. I think your majority of assets are in your core. You've got a couple, those core ETFs are market cap weighted index tracking ETFs. And what that means is it's not trying to make active decisions on we're going to buy and sell particular companies. It's just we rank companies from largest to smallest in a market, and that's what we own. And then they give you a low-cost way to own them all in one trade.
Yeah.
And so that gives you the market average return. Obviously, then you have 2 that have leverage, so they amplify the returns and the losses a little bit. And then your satellite holdings you don't need to be incredibly diversified in your satellite holdings because your core is incredibly diversified.
Yeah.
So you just own a few stocks and some crypto and an active manager that you believe in.
Yes. Yeah.
Nice. And over the past 5 years, you've done almost 29% per annum. So you'd take that.
I would take that. Absolutely take that.
Yeah.
Yeah. Yeah.
Good stuff.
I feel like you have some numbers that you've
We'll
plugged in.
We will get to that.
You've just plugged in.
We will get to that. But I would say if you are delivering 29% per year, pat yourself on the back, keep it real, and eat a burrito.
Very much so. Very much so. Now, that's a good point to pause here and thank Guzman y Gomez for supporting this Real Talk series. Now, Ren, you've been bringing some stats each episode on some of the interesting, takeaways of how we're consuming burritos around the country. So what have you got today?
Takeaways or eat in store, whichever way you want to do it. So today I'm talking burrito fillings. I've got the stats here on the most popular burrito filling. So it's going to be a two-part question for you today, Bryce. First part of the question is which filling do you think is the most popular? This is ubiquitous. This is across all states.
Meat, protein.
No, okay. No, like which filling?
Oh, which of them?
Yeah.
Okay. Spicy chicken.
Chicken was the first
chicken.
part.
Nice.
Okay.
Yeah.
All right, then the second part of the question that you're jumping ahead, spicy or mild?
Spicy.
You think is the most popular?
100%.
No, mild chicken number one, spicy chicken number two.
I wonder why they don't just call it chicken and spicy chicken. We'll have to take it up with them.
I don't know. Anyway,
I'm surprised with that. I would have thought spicy is the number one. It is an absolute no-brainer for me.
Well, I mean, to speak to my personal experience, my housemate Flynn couldn't deal with the spicy chicken. Too spicy for him.
No way.
So shout out to Flynn. But look, however you want to build your burrito, you can at GYG. Customization is the name of the game.
It is.
Extra spicy like Bryce, go for it.
Not only that.
I'm on a flow here. Extra mild like Flynn,
yes,
go for that as well.
But I would also say that if spicy is not enough, add the jalapeno salsa and the smoky chipotle and
the habanero hot sauce.
And away you go, from the salsa station. That's it.
However you want to customize it, make it your own, you can. You can also do it on the GYG app where you get a free burrito where you sign up for their Gomex rewards.
How good.
You can earn points on every order and you can get it delivered through the app as well.
That. So keep it real and eat a burrito. Alrighty, Ren, I've pulled the curtains back on my portfolio. Now it is your turn to do the same. Let's start broadly. What is the construction?
Yeah, so I try and run a third. So core is a third of my investments.
Yep.
And then a third is in active management. And then a third is in satellite positions. And I think the majority of people's assets, and over time, I think the majority of my assets will be in core, these index tracking ETFs. The reason they're not now is just because of the NAB equity builder.
Yeah.
And so that's...
Which is?
For people who are unfamiliar, it's an investment loan that you can borrow money and invest. The reason that we like it, the reason that I like it is rather than being a margin loan, where the market falls, the bank will call you and say you've got to put more money into your account to keep your collateral at a certain level.
Yeah.
The NAB Equity Builder product is the only product we're aware of in Australia that gives a mortgage style principal and interest loan to invest in stocks.
Yeah, so no matter what happens to the share price, your repayments remain consistent.
Yeah. So I've had that for years and I use that to access some active managers that I didn't have the money to invest in without borrowing.
Yep.
And so that's why my active bucket is high. I think over time, I'm going to redraw some more money out of that and just put it into core index ETFs, because you can also invest in index ETFs through this equity builder product. That's the reason why right now it's a third.
Yep.
But over time, I would like it to be, 60-20-20. 60% core index tracking ETFs, 20% active managers that I believe in, and then 20% my own stock picks.
So not to go down a rabbit hole too early, but some might question after hearing Pimp My Portfolios and the like, why not just sell down and make that rebalance now?
It's a good question. I just don't want to deal with the admin of selling.
This guy.
I would rather...
The laziest investor you'll ever meet.
Yeah, laziest investor, and just wait until you see how I'm going. I would rather, keep building, let those active managers who are doing fine keep ticking away, and rebalance by addition rather than rebalance by subtraction.
Yeah.
And what I mean by that is put more money in and grow my investment base so I can then borrow more and rebalance it by then putting that extra money into where I want it to go. Rather than then I got to deal with capital gains.
Yeah, it's fair. It's not like the active management side you want to get rid of.
Yeah, there's no burning platform. There's no problem here.
Yeah. Okay, cool. So 30, a third. Ideally, get the core to sort of a higher weighting.
Yep.
We'll take us through each of them then.
Yeah. So as I said, I traditionally have run spreadsheets, and I would do a quarterly portfolio review in a spreadsheet, and I've got that going back sort of 6 or 7 years in a Google sheet. It's pretty interesting to have a look at the old tabs and see how much it's changed. But I have made the plunge to set up ShareSite.
Nice.
And I've got to say, because I first tried to set it up early days of us doing the podcast.
Yeah.
And I remember just thinking, giving it a crack and being like, it was too administratively difficult to put all my trade history in.
Yeah.
And so that's always been sort of a blocker for me giving it another try. But I did give it another try in preparation for this episode, and credit where credit's due, it is so easy now.
Yeah, it is. It is.
The AI must have got smarter, or whatever's going on in the back end must have got better, because now it can just read the transaction histories and just go bang.
Yeah.
And I'm sure that's been the case for years. It's just that I haven't retried it for years. So I'll start with my core.
Okay.
And I'll tell you what I've got, and then I can tell you my total return really since I built this portfolio. So for ETFs, US stocks is the iShares S&P 500 ETF,
Yep.
IVV. Aussie stocks is the iShares Core ASX 200 ETF, IOZ. European stocks is the Vanguard Europe Shares ETF, VEQ. And then Asian stocks is Vanguard Asia ex Japan, VAE. So 4 ETFs, low cost, market cap weighted index tracking, and that gives me pretty much a broad exposure to the world. I try and hold them in equal weights. They're all sort of within a few percentage points of each other in terms of size in the portfolio.
Yep.
That obviously just drifts because they grow at different rates, but I put the same amount in, and when I've got a bit extra, I'll top up ones that are lagging behind. Since I sort of built that core, so in 2020, 16.4% per annum return.
Nice.
Take that.
Yeah, absolutely.
I benchmark it to the ASX 200 in ShareSite. In that time, the ASX 200 has done 10.1%.
Yeah, I think S&P is what would be about probably closer to your number. I reckon.
Yeah.
Solid, which is what it's exactly supposed to do.
Oh, no, I mean, people talk about an 8% return.
I know. Everyone listening is saying when we even do 13%.
Look, people are like, you guys are young, you're...
Yeah.
But it's like, we've been investing for 10 years now. It's like, you've been investing for longer, but yeah. Anyway, 16.4% return a year. I'm more than happy with that. So then the active management part of my portfolio, there's 7 thematic ETFs and active managers that make this sleeve up. So the 2 thematic ETFs, the BetaShares Global Cybersecurity ETF, HACK, and then the Global X Semiconductor ETF, SEMI.
Yep.
And then 5 active managers. So to just run through them, Munro Global Growth, Magellan Global Fund, Alfinity Global Equity Fund, Fairlight Global Small and Mids, and Hyperion Global Growth. So obviously a real bent towards global, a real bent towards growth. I guess also if people are familiar with those fund managers, they'll recognize there's kind of like differences in the types of stocks they're investing in. And that's what I like in terms of different focus, I guess.
Different
philosophies.
Different philosophies, different ideas on the market.
This portfolio, again, since 2020, has delivered 13.82% per annum.
Still outperforming ASX?
I mean, the really interesting thing for me here is that my core index ETFs are outperforming these active managers.
So that would be total return, obviously, after fees.
Yeah.
So that probably has a bit of an impact.
Yeah.
And some of those fundies as well are like high growth.
Yeah.
And the last 5 years, well, I don't think that's an argument. It's been pretty good for growth over the last 5 years.
Yeah.
Yeah, that is interesting.
Yeah. So anyway, look, as I said, not a burning platform, almost 14% a year. The fact that I'm also then benefiting from the leverage that I'm getting from the NAB equity builder, like my return on equity is even higher than that.
Yeah.
Okay, and then it goes to my satellite portfolio.
Okay, here we go.
You'd be proud of me, Bryce. I did a bit of a cleanup recently.
Oh, you did?
Yeah, I sold about 10 positions.
Oh, wow.
Yeah. Still have
For context, if you've just joined us, still have 15. Well, there you go. Ren had up to 25 individual positions. Yeah. Never a man is so excited to buy after talking to an expert or reading.
I say every episode I'm excited for this episode. I am excited. How can you not be excited by the opportunities that present to us? That is the joy of investing. You can find some of the smartest people in the world working hard to make you more money.
Yes.
And from the comfort of your couch, you can put your money to work with them.
Absolutely.
So, in that vein, I'll start with total returns. So this includes closed positions, so positions that I've sold, the duds, the ones that I don't believe in anymore, back to 2018. Total return, 63.4% per year.
Nice. Per year?
Per year.
Oh, that'll include A2 milk.
It actually doesn't include A2 milk because that was before 2018.
Okay.
Yeah. That was ComSec days. ComSec's
Okay.
Yeah, so it does include crypto. Taking out crypto, it was like mid-40s.
Okay.
Yeah.
Solid.
Yeah, pretty happy with that.
Yeah.
If I can grow in the 60%, doubling every 2 years.
Yeah, of course.
My portfolio today, I've got 5 Aussie stocks. Did a big cleanup there. Catapult, Cochlear, ResMed, Macquarie Group, WiseTech, and Guzman.
Nice. Got rid of Hit IQ.
Got rid of Hit IQ,
I'm trying to think what else was in there.
BHP, I got rid of.
That's a fair call.
Botanics, I got rid of.
Yes, fair call.
I got rid of Minres.
Yeah, fair call. Cool. Okay.
I was torn about that one, but I thought it was probably...
always opportunity to get back in.
So I think just to talk about my philosophy with some of these stocks and some of the ones I cleaned up, like, I still believe that, like, BHP is going to be a big winner from the green metals transition. But it's like the time that's going to take, the fact that their iron ore business is still going to be the bigger driver of investment returns in the near term, and the fact that the iron ore market seems to be is slowing and doesn't seem to be turning around anytime soon. It's sort of just like, sure, I still sometimes believe in the long term, but the time it will take to get there and the opportunities that I'm missing along the way has led me to not go there or to sell it.
Yeah.
In the US, my holdings are Axon Enterprise, Coinbase, Eli Lilly and Novo Nordisk, C Limited and Jumia Technologies, Spotify, Shopify and Transmedics.
Nice. Oh, Trans is in there.
I kept Transmedics in there. Yeah, I believe.
Yeah, it's a good story. Okay, so you've cleaned it up. Still, like 15 stocks is concentrated, really. Like,
well, it is and it isn't. Like, it is if that was my whole portfolio.
Yeah.
But I've also got these active managers and these index ETFs.
You've got a third, 14% a year, 16% a year, or no, 14, 13, or whatever it was, and then 60% a year.
Yep.
What's then, bringing that all up, what's total return for the
since
portfolio?
2018, 30.9% per year.
Solid.
I mean, not too far off what was yours?
29.84.
Does beat you though.
Yes, just.
Beat Bryce in investing?
Mine,
Keep it real, eat a burrito.
I've gone last 5 years.
Well, go further out.
If I go to the very first day that I bought a stock, 2003, 16.83%.
Yeah, but I mean, you're shooting yourself in the foot there because a lot of those early days, you're just relying on Brickworks.
100%. Yeah, nothing changes until really 2017.
So you've gone ShareSite all the way back to 2003.
Yeah, as far as I could. There are some positions that it wigs out on, like it's not perfect.
Oh, okay.
Yeah, it's in here, December... Oh, the furthest I went, 28th of December 2004.
Wow.
I've got my Brickworks position.
Full credit.
17% a year for 25 years.
Yeah. If only you'd invested more money in it. Well, look, I think that's our portfolios. It's always a vulnerable position when you share everything you own. So don't shoot us too hard in the comments on YouTube or on Spotify.
No, listen to us. This is why we say all you got to do is the average market return.
Yeah, like let's get real in this Real Talk episode. That's the takeaway for me. It's like for all the bells and whistles, for all the companies that we get excited by, for all the noise, two idiots who didn't study finance, who didn't work in the industry, who didn't really know anything and are just trying to self-educate and learn, can deliver returns that can change our lives.
Absolutely.
And it's not because we're smart or we're doing anything special. It's because we've just done it consistently.
Yeah.
And anyone can do it. These low-cost index funds are easily available and a great place to start. And then as you get familiar with the market over time, you learn more, you figure out how it works, you get excited by some opportunities, then you start adding some satellite positions around it. But nothing that we've spoken about here is out of reach for anyone.
No.
So get started investing, and then to celebrate, keep it real and eat a burrito.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.